All right, how we doing tonight? All right, can you see my screen, hear my voice, and are we crystal clear? All right, hey everybody. My usuals, Kevin, Sean, what's up? Moshi, how you doing? All right, let me just get into it. Okay, I'm going to skip the disclaimer. I've been reading it every day in January. All right, welcome new guys. Let me see who's here. Say hi, man, if you're brand new. Happy to have you in here. All right, I'm going to skip all this stuff tonight. Got a lot of chart stuff to look at. But Jim Rohn, one of the books we talked about, motivations was to get you started. Now you got to be in habit mode. You're excited first of the year. We're into February. It's almost Valentine's Day. February's moving along, a couple days away. Now it's all you. Lee, how are you? It's on sheer guts at this point, man. You got to just push yourself. All right, so new guys and regular guys, we run it like a business, man. You run this business like a business. We use a book called The 12-Week Year. We only use audio books in here. If you have time to read a book, you shouldn't. You should be looking at charts. Listen to an audio book in the car, go for a walk, whatever, exercising, use audio. The other point too about using audio book is if you make a reference and you say, hey, Steve, what happened in chapter 5? It's different on audio than it is in paper. So if you tell me chapter 5, 15 minutes in, I can go right to that point and I could answer your questions. All right, so only audio books. And if you got time to physically read a book, you need to be looking at charts. Okay, so look, we're about halfway through, man. We are middle of the way for the first quarter being behind us. So this is like a follow-up checkpoint, okay? This is for new students, but you know what? It's for old people I don't mean old people, older students, sorry. And guys that just are having trouble and can't get the let out, whatever it is, this is for you. So at this point in your year, you should have a better understanding of how your personality plays into trading. I issued a trading quiz first of the year, second week of January. You should be at a point where you know I'm a swing trader. I like spot trades. I like intraday. I like to hold it for a week, a month, a year, whatever. You should know this about yourself. The whole point of that is so that you're not going against your nature or personality and stressing yourself out needlessly. So you should be at that point. You should at least know, you know what, man, I like intraday stuff. I like to be done. If you're, I don't know what my personality type is. I think it's called type A. I don't really know, but whatever. If you're high strung and crazy and like can't sit still type of person, if that you fall into that, you're probably an intraday trader to be flat at bedtime or flat when you're out at the end of the day. All positions closed. That's my style. I absolutely know it. Okay. You should have a plan developed and being tested. Okay, that comes from legwork, using the viewer, back testing, going through. You should know where your stops and limits are going to be and testing. Okay, if you're trading a pair with a big spread or a pair that maybe doesn't have a lot of liquidity, that's erratic, like pound, anything pound yen, pound odd, those crosses, pound Swissy, you need bigger stops than a normal traditional stop that you would get either in a futures contract or that you would get in a like a standard pair like EU or GU. You should know that. All right, you should have done or in progress of doing some of the drills. They should be in progress or completed. The high-low drill. Nobody wants to do this drill, but everyone that does it goes, I don't know why I didn't listen to you. That's literally has been happening for going on 11 years now. Okay, so the always in drill, that's a little more difficult, so I understand, but the high-low drill, you could do that any session, any time of day. You draw a line where you think the high is going to be and you try to snag it within 5 to 10 pips using a 5-pip stop. Okay, it could be fading away and you could put it on and then a 5-pip stop above the high. That's the drill. And pick a pair that you're going to use. Don't pick some rando pair and then all of a sudden when you go to actually trade, you switch off. Test the pair that you're going to trade. It sounds so simple. Like, yeah, do the high-low drill. Okay, do it. Send me the results. Open up a demo account you don't care about. Take one contract. I don't care what it is. Pick the pair you're going to trade and try to catch the high-low in the second leg within a few ticks of the swing high. That's the business. All right, let's see. 30 trade assessment. If you've done the drills, TDI only drill, and you're doing the drills, then you should be, hey Andrew, you should be doing a 30 trade assessment. Okay, remember we do 30 trade assessment in blocks of 10, and I did a win the day webinar versus straight money management versus 3-bet 50, whatever style you're going to choose. You got, if you're like, what the hell is this guy talking about? Go back and watch the webinars. That's the beauty of technology, man. I used to do a webinar, it was gone forever. Now it's recorded, posted, you have access to it, you can scroll through it. And then if you've done all those above points that I just read, then you need to be in a no reset demo. Okay, so what's a no reset demo? You pick an amount that you're either going to deposit or try to qualify for. If you're going to qualify for 50,000, then you make a $50,000 demo, and you do not say, oh, I screwed up and reset it. You work your way through the whole way to either qualify or bust. Okay? I don't know what the criteria is for qualifying, but do not spend any money on qualification if you're not at this point. If you haven't done all those bullets, you got no business handing these guys $1,000 to try to qualify, period. If you go through and like read their rules and criteria and they give you a free demo, they were doing free demos for a while. Okay, so Sean just posted 10% first stage, 5% second stage. Is that draw? Is that return? Is that max drawdown or return, brother? I don't know. So just go read the rules. Okay, you got to make a 10% return in stage 1, 5% in second stage. So, okay, that's reasonable. And then you got to know what the max draw is, what it takes to bust, how many trades you need, how active you got to be. Okay, 5% daily is max drawdown. He's answering the questions for me, so I'm just conveying it to you. So listen, whatever it is, you got to meet the criteria. So do it in a demo. Why give them money? If you can't do it in a demo in your own account when no one's watching, there's no way you're going to do it paying money to them. So that's where you need to be. This is where you are. I'm checking you right now. Check yourself. Where are you? Okay, the year started. You were excited. New Year's. You made all these promises. Okay, remember the curve I showed you? Okay, you know how I know it's waning? You guys are falling off? The homework stopped. Handful of people are still sending it. The rest of you don't want to be bothered. So that's where we're at. And I know it because this is my, 11th or 12th year doing this. And it's the same SSDD, man. I don't have to say the word. It's the same stuff, different day, different year, SSDY. Everyone starts off excited, they're in, they're jacked, and then by February, they're on to other things. I need you guys to get repumped, man. All right, here we are. Get my pen, talk about it. Gone. Okay, we're sitting, where are we sitting? Right here, the 9th. Monday's Valentine's Day. I give you the day off. If you're married, have a girlfriend, boyfriend, whatever, I give you the day off. Spend some time. All right, make a long weekend out of it, whatever. Give yourself a mental break. But look, it doesn't take rocket scientists to figure out that this is the midpoint between here and here. So you're targeting April 1st. It's not too late. Readjust, mark your calendar, and get re-engaged. This is the part, right? This is like they say all those old cliches, the men separate from the boys, and I guess it would be the girls from the women. Nowadays we got to include that, right? To be fair. Okay, this is where you're at. You got to check it. We're about halfway through the cycle. April 1st is coming down on us. It's going to be spring. Then you're going to be like, oh, it's spring. I've been cooped up all winter. I got to get outside. I don't want to do this shit. Okay, well, then why are you here? Give me some love, man. I'm sad because I asked for a skill and there's only one guy who sent it in and he knows who he is. He uses NinjaTrader. And that broke my heart this week. All right, man. Best skill builders, I've talked about it. High-low drill, just talked about this. This is the rules from it from last week. You don't need me to go over it. Okay, last night in the 6B contract, which is pound dollar, they were giving it out all day, man. You can't draw this any better than that right there. Okay, you got a fake drop, take out the breakout traders, trigger the stops over here, push into the high, perfect M formation, shift through right there on the hammer, that's the entry, and then you could use the zones to trail all night. There's your crossover. It was perfect. And this was good for, I got to put glasses on. It went to noon. I didn't get the whole run. It was good for about 45 pips. All right, and then you got this flat print in here on the changeover pulling back, right? Coming into the US session. And then you go sideways. Look at the time on the bottom. This is New York time on here. Right there. End of the day. You're starting to get out of there and you get this sideways print the rest of the afternoon. Typical stuff. All right, thanks, Dylan. Appreciate it, brother. All right, man. So I want to go back real quick, just refresh your memory. We're talking about get into some charts, book map, and all that stuff. All right. So I'm talking about the candles, right? How the orders print, right? It's inverted. It's opposite of what you would think. And this is order flow, right? We're talking about this blue line is the heaviest volume exchange on this particular POC, 675 contracts versus 10,000 contracts. But remember, it's diagonal. Okay, the dealer pays across even money. You pay a spread or a higher spread. That's how you get filled. Okay, we talked about it last week, right? Okay, we were looking at this trade. You guys remember I took the 12 bars inside of the 1 hour. That stuff you got to break down, all right? There was a couple charts lingering that I didn't get to finish, and I'm just going to give it to you right now. Forget about the numbers and all the stuff I talked about last week. Just tell me what you got, all right? I'm going to give you, I guess, a minute. Give me a quick pop quiz and tell me everything you see starting now. Yep. Thanks, Dylan. Thanks, Sean. You're on it, brother. All right, what do you guys get? What'd you get? Forget about all this crap on the chart, okay? Forget it. Because these candle patterns exist whether you can see this stuff or not, whether you know where this cluster is or the VWAP or the POC, it's irrelevant. That's the whole point. Okay, so what do we got? We got a nice, right, outside bar into the low, rejected. Right, now you got your consolidation levels. This is your box. Okay, the dealer is trading off of the low. Right, so if you wanted to box this in, you could technically draw this using an aggregate of the body. Right, at the time this prints, maybe you only have 2 bodies, maybe you have this. Okay, you can just get a rough estimate off of the low side wicks and part of the body, right? Okay, so now remember we talked about points of control. Points of control is the highest volume exchanged at that point of the candle, right? It's the most order flow that came in. But notice something about the POCs. They're in basically a clustered area on top of each other, right? So understanding that these bars, right? Someone said it and I was proud of them. There's no net change in price. It's up and down, up and down, up and down. Consolidation, absorption. And we know what that looks like in the book. We're going to look at that tonight. All right, then what happens? They spike all the way to the low. So the people that are trading this pattern, continuation down, see this massive bar open, right? We know that this closed here, open, and went straight red. Right? It opened here, went straight red, and said, wow, there's my confirmation. If you're trading a smaller time frame, it probably looked like a bunch of little red 1 minute bars or whatever going down. If it was volumetric bars, I already know the volumes were high right here. Look at them. So the volume bars were printing low side. So it gave the continuation appearance, but you have to be smarter than that. You got to look at this consolidation period right here and realize when this turns inside out and paints as a full rejection, they got them. Notice something pretty cool, and you don't need the tool, but just understand this POC, this cluster and the POC being up here, they poured volume into this candle at a high rate and a high number to get it to finish out all this. Remember that stuff where there's a hole in the book and they pop a Pac-Man on there? This is Pac-Man right here. This is where the Pac-Man starts. These are Pac-Men. These are the absorption bites out of the book to collect the orders and then get it. So this is basically on a different time frame. You can't see red on red. This is basically, if you take this out of the middle, this is basically a set of railroad tracks. When you look at a railroad track on a 1 hour chart or a higher time frame, you can't see this activity in here. All you see is this, right? A bar in and a bar out. That's all you can see, right? But understanding that these absorbed all this and then they used heavy order flow to get out of that area because they probably had orders in the book and they had to flash this candle heavy to come out of there and trap. Think about what it took for them. Look at the numbers, man. Look at the numbers it took for them to flush this down to the low, trigger the stops on these guys that were trading too tight, right? Weak holders. How about the guys that chased the bar here and chased the bar here and got in, that are long right here, right? How about the guys that chased the lows and sold short here? Amateurs, right? You don't execute in here until you got this, and then you're looking for where the book flips. Where does the book flip? Okay, so the next question is, well, this is the answer, right? We had a low of the day accumulation, outside bar low POCs, right? POCs inside. This bar has a low POC. Trap traders chasing price, making false downside projections, right? I told you that. They're doing this in their head, and the dealers ain't doing that. You notice POCs towards the low, then they shift to mid-range. You got heavy POCs coming out, right? High points of control. The bar opens red, and when it flips green, you're too late, man. Sorry about your luck. You're trapped. Trap traders. That's what it's called. And it's not something I made up. It's physical term, trap trader. Talk about an order flow, institutions, trap trader. Guess who that is? Retail guys. Most of the time it's retail. I guess very few institutions get flipped upside down like that. All right. So draw the zones. Draw the zones for me. Ready? Go. I'll be quiet for 30 seconds. Take a screenshot. There's a little tool in the corner, has a picture of a camera. Take a screenshot. Mark that shit up. All right, what does it look like? Walk me through, man. Somebody give me some love tonight. All right, my mic's on, right? Let me look at this thing. Yeah, okay. All right, nothing, crickets. All right. Next question. Where's the trade? Mark the trade. Take a picture, mark the trade. I'll give you like 10 seconds. All right, cool. All right, so look. So this is a typical W formation, right? Okay, so where's the trade? We're looking for book stuff. We're looking for refined entry. No, the trade is, this is not the trade. In the old days, that was a trade. Before, listen, Someone's been asking me questions like, what about your class from 2011? Yes, that's the foundation. That class was created before Bookmap, order flow, and this stuff was available to me at this level. Okay, new decade, new concepts, new ideas, constantly improving your craft and working on the business is what you should be doing. Okay, so once you master the foundational stuff, the basics, the 2011 stuff, and understand it, now you got to zoom in and you got to make better entries and you got to be a better trader. Why? Well, I'm still not driving a 19 B210 Datsun. I can't remember the year. When I was a kid, that's what I used to drive. Should I still be driving it? Right? No anti-lock brakes, no airbags. Barely had I think I had a lap belt. I don't remember. Okay, so things change. Things are better, right? Now you got backup cameras, sensors. Car takes the wheel away from you, applies the brakes if you screw up. Okay. So guess what? Technology and advancements have come along to guys computing at the house with this stuff. You could see order flow. You could see things. Make adjustments. You got to be better than you were 2 years ago, last year. You got to be better, even if it's just in your habits. If it's just, man, last year I joined, I was going to do the homework, I didn't do shit. This year I'm going to do it. All right, that's the difference. So that's your difference this year. Be better, be smarter. Okay, so now we know because of order flow and lines in the book and the things that weren't available to me 20 years ago when I started. Okay, if you're still behaving the same from 5 years ago, 6 years ago, you got to have some growth, man. We need some love out of you. All right, I'm being tough tonight because I only got one homework assignment that I asked for last week, and I'm like shattered. I thought for sure they would pour in over the weekend or Monday. Nope, waiting Tuesday, nothing. All right, well, here we are. Thank you, by the way, Moshi. Appreciate the love, brother. All right, so look, you refine the entry. How do you refine the entry? That's the trade right there. How do we come up with that? Okay, price breaks above. Price breaks above. They took out the level. The book is long side after all this work, right? Okay, now we got a long side book. We refine the entry. The zone flip is here, right? That's the apex nadery thing. The zone flip is there. So if you just use the zone flip, you'd have a trade. But you want to refine the entry. You want to use lines in the book and order flow stuff to give you a rough idea. Okay, remember I talked last week about this cluster and this POC. That is going to be where the zone should be. Oh, Steve, I don't have that. Okay, you don't need it. Why? Because when this candle closes, the next candle almost always opens, right? Remember Carr's 1/3 rule? Okay, well, if the POCs on a shift candle take out the level, most of the time they have to put the point of control right around the apex nadery thing. So the next candle that opens after the shift bar will retrace down to roughly where the cluster is or the highest volume exchanged. And it happens to be right around the top of the apex nadery thing. So you can take this right here after this first rejection draws, and you can expand it out into space and time. That's your zone. So now you can cut the box in half. All right, let's say I didn't measure it. Let's say it's a 10 pip box. You want to go buy limit order, BLO, right? BLO and SLO, sell limit order, buy limit order. You want to go buy limit order, middle of the box, and lo and behold, dealer spikes down, tapers off the candle, caps it with some heavy volume, and he's gone. Within 5 to 10 minutes, you are seeing a profit. You had what would be a damn near zero entry. If you went mid box, 1, 2, 3, 4, 5, 6, maybe, and one for the spread if you're trading futures, depending on the instrument. This is pound dollar, I think. Okay. No, I'm sorry. This was crude oil. 1 pip spread, man. So you had 7 pips of draw, and you had 10 pips stop. You were safe. And the opportunity, this went for, I think, I want to say 100 pips. But crude oil usually goes for 75 cents to $1 regularly. Their impulse moves are aggressive. And you're in a zero draw trade. You enter here, your limit gets in, right? It spikes down a couple pips against you and closes here. On the next 5-minute bar, you're already up. And that, you shift out of there, you take out this, now all of a sudden it's shift, 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 you're gone. And you don't need the tool. Look where the POCs are. High side POCs, What gives you the idea it's a high side POC? Very little wick on top, except for this one, and a high side balance, right? The candle closes hard and strong. Very little retracement into the lows, right? Very little retracement back into the lows. And if you notice, here's the cluster. Candle opened, found rest on the body right there, spiked down and reversed. Here's the cluster, candle opened, didn't even bother coming back into that area, gone. So if you executed here, 5, 10, 15 minutes, you're in profit and you're almost to break even if you're not already to break even. So this is, you got in 87.30 and in 5 to 10 minutes, you're at 45, you're up 15 ticks, you can go to break even. If you got a zero entry, you're at break even, it's never threatened. You literally can leave the stop alone and go about your business. But always want you to get break even before you walk away. Your job is to get on a trade, tight stop, get it to break even, and leave it alone, man. That's your job. Go do something else. I walk around the house, clean the kitchen, do weird stuff, load the dishwasher. It helps. I make it a multitasking type thing. Once I get to break even, I walk away, right? And I was taught 22 years ago to close your P&L. The best thing you could do for yourself is close that screen or minimize it. Don't look at it. Because why? Because when you opened, right, and then it went against you 7 pips, you're probably like, oh man. And then what happened? It went all the way up and you were up 10 and then you closed over here. Now you're up 3. Then you get a nice shift. Now you're up 15 or so. Then it opens, pulls back, you're only up 8. Then you're up 20. Then you pull back and you're only up 18. This is the kind of stuff that freaks you out. So if you watch your P&L numbers, you're like, oh man, I had $1,000. Now I got 500. Now I got 700. Now I got 300. Now I got 2,000. That's the way the business works. So what was told to me is look at the chart, not the money. Look at the chart, not the money. If you take away one thing from tonight, it's look at the technicals, not the money. Okay, how do you do that? Close green high, close green high, close green high. That's technical. Money, up and down, up and down, up and down, drives you absolutely insane, and you'll tap yourself out and throw it away. Okay, so we're talking about sequential decline and tapering. If you guys remember what that is, I got some stuff I want to show you. That's where order flow starts to decrease at the edges of a structure of a bar. Okay, so it's a mouthful, but if you picture a bar, right? Picture a square bar with wicks on both ends. Okay, and draw like a pyramid, and imagine that the orders in these levels are decreasing down, right? We know the bar's cut in half. You know I can't draw with this mouse, I'm sorry. Okay, the orders are cut in half, and picture the numbers, higher numbers here going down to 0 or 1, right? The collection of these is easily noticeable. You don't have to have the tool to see it. It's the way the wicks are and where the bodies stop. When the body stops, they usually start to taper away and trade thinner volume into those levels, right? And I told you about trap trader. That's a term that the institutions coined. That's where it comes from. It comes from the tapering of the candle into a sequential decline, tapering, whatever you want to call it. Tapering I made up. Sequential decline is what they call it. It's the numbers declining into 0 and trapping traders at the absolute worst possible buy or sell, right? And this is what comes on trading closed candles at the absolute worst possible time, right? If you get a crossover down and it's the absolute worst place and you execute on the close right here, then you are considered a trap trader, and then they pull out of there, right? The trap trader tapering demarcation is the absolute opposite of what the dealers want to do. I mean, what they're showing their intentions. So if they show you, right, if we go back and look at this chart, right, you start looking at this, right, you got sequential decline in all these numbers, right? They start tapering. Look how low they get, how small they get. Look how small they get at the bottoms, right? Right? These are bigger numbers than these, but relative to what happened in the bar, these are smaller numbers. So before they pull away, you got all these guys trapped at lower levels. There's always some number trapped top and bottom on the outside of the wicks because they show, and I always think of my guy Dave. I don't know if he's in here, man. I always bust his chops, but when I first met him, he screamed about a candle that was a huge spike candle. And before he met me, he would have chased that into the market, and it pulls back and turns all wick. Right? I always joke around when I used to do it in person. I used to pull my pant leg up on my suit and say, "This is what it's like. It's the pant leg's all the way down, and then you slide it up, and there's my skinny calves and my ankle." And it was probably pale back then too. Who knows? But anyway, it's like your pant leg went up, they pushed it all the way back down and pulled it up, and you're stuck. And that's what it looks like. An exposed ankle bone or whatever, a leg, calf, whatever you want to call it. But that's what tapering sequential decline looks like, right? So what happens is that sequential decline in a run doesn't mean anything. These are in the millions, these numbers, by the way. They can't print the big, huge number on there, so they print it in decimal. Like this 14,600,000 exchanged on here. So anyway, look. So price is running up. You got a sequential decline there. It's everywhere. It's just when it's perfectly tapered is when they mark it on these charts. Do you need the tool? No. You know what you need? You need to realize that this is what a wick looks like, and this is what the candles are doing, right? This is exact opposite of what we just looked at on the bottom. It's the exact opposite, right? So what would happen here? This would be, right, your outside. If you counted these two bars or 3 bars on a 15-minute chart, right, 5, 10, 15, this would be one big outside structure with a rejection high side. POC's middle, right? Look at the points of control. Look at the candles. Look, spinning top, points of control in the middle. Okay, so now you have a collection. So we're talking about boxing in the market. Where's your boxes? Where's your boxes at? Okay, let me grab a pen, sorry. All right, or not. Come on, let me see. All right, there we go. This is your high side box, right? Where'd you come up with that, Steve? It's a terrible drawing. It should be down here, right, to the top of the real bodies. Draw it across. Okay, you know what? I got to do it right. I'm driving myself crazy because this way you guys can see it. Okay, you go to the top of the real body, aggregate it. Maybe it would be like this. Right, and up to the top of the wick. That's the correct way to draw it. It should be here, sorry. Okay, that's the correct box. Okay, so you're taking this spinning top happens to be incorporated. You got these body tops. This closes 3 ticks in. Okay, you got a rough idea. Rejects here. Okay, so where's the trade? The trade is here, right? You would put sell limit order, middle of the box, and you're going to get filled sequential decline, sequential decline. These are signs that the energy to the top side's waning, right? They're capping it. How do they cap it? They make an outside bar. They stay inside the range of those bars, and they create, right? This is your bottom box. Okay, now you have 2 boxes. All right, so this will be your high formation. If you don't trade the high, right, look over here to the left. You get body closes. This is outside bar, consolidation, nadir, pullback, failed auction high, break below here, close below that. Now you got to confirm sell side, looking for a retest to go short, or you're waiting for a close below here and a retest lower here. So you got to trade here or here. This is an intraday safety trade. This is a zero grab at the high of the day. Same thing. Same thing. Which one's better? Neither. They're both fantastic entries. Right? Remember, if you start thinking a thing in microstructure, start moving things down in microstructures, we're trading ranges, right? So you're trading high of the day, low of the day. You're trading high of a candle, low of a candle. You're trading on a 15-minute chart. You're trading a 5-minute chart, high of the candle, low of the candle. But you're trading like a dealer, right? What bug me about this, where this came from is, okay, I see sequential decline. I see all these numbers in this bar, and that pissed me off. Why are they getting the deal there? Why am I trading on a cross below a 13? Well, I'm trading there because 20 years ago I couldn't see anything. So now I started seeing millions of dollars flowing at these top edges and bottom edges, fringes, whatever you want to call them. I started seeing all that money flowing there, and it made me angry. Because why can't I deal there? What's the reason I can't deal there? Wait a minute, there is no reason. Who told me I can't deal there? Every retail trader I ever met or talked to, except the guy that trained me, told me I can deal there. Everyone else told me you can't deal there. Okay, well, guess what? In 2014, this stuff became available to me on Bookmap and other heat maps and stuff like that, where I can see the numbers, and it made me mad. And I literally camped out 20 cups of coffee and sat in front of the screen and figured out, why can't I deal there? And I answered the question. I need some kind of, what do I need to deal at these crazy levels? I need to understand what's going on. I need to see some kind of structure, and I need to see some kind of pattern that these guys print on a regular basis inside with those numbers. And that's what I gave you, because I gave it to myself first, and I proved the model out, and I gave it to you. And there's only one guy that answered me last week. So I'm a little hot today. I love all you guys. You're like my students, my children, whoever you want to call yourself. But I need some love back. All right, so look. So once you understand all these numbers and what you're looking at, throw this shit in the garbage. You don't need it. You don't need to go out and spend the money on the tools. I already did it. And I don't even look at them anymore. It's too much. It's too much stuff to try to decipher, trap trader, tapering. It's too much. But the thing is, you need this to understand how to get those entries, how to get the hookbacks, why it hooks back. All right, so that's where we are. I'm talking too much. All right, so this is just a blow up of it. Right? We know that we draw a box, right? This is the perfect entry because you have a failed buyer's auction. Buyers can't run price above the last swing point, and then they take out the swing low. They run price below the last swing point. Now you're looking for this, right? You got top side high. You need a print below the apex nadir and down. Retest in, refine the entry off of this side. So this gives you the rough idea where it should occur, right? Apex nadir, stretch that out into time. Then you get the first print after they shift below and the rejection into that level that refines the entry and helps you draw your box. That's how that comes, where that comes from. I looked at, I don't even know the number, man, hundreds of hours. I just sat there like, if I smoked, I would have been chain smoking, drinking coffee all day. I do drink coffee, just sitting there. My wife was like, come to bed. I go, in a minute. And it was like 6 hours later. Come to bed. I go, in a minute. You know how that goes. When you know something's in there and you're trying to crack it, that's what happens. And I spent hours upon hours. I never turned it off in my office. Always walk by. What is it doing now? What is it doing now? And it went on for months. And then I figured it out. Just one day, you know what happens, right? Like I had my epiphany in the shower. I went for a walk, got away from it, exercised a little bit. And then I started realizing, right? It's a retest of the apex nadir after the fact. Refine the entry on the first rejected bar because the bar paints back to the previous number where the point of control was. And that's how this came to be. Okay, I noticed that some people can't believe it, can't believe that it's that easy. But it is. They feel like they got to buy the tools. There's a couple guys in the group. I said, don't buy the tools. They went and bought the tools. They don't listen. And they wrote me and said, I bought this tool, and just like you told me, I can't make heads or tails of it. Yeah, because it takes screen time, man. I don't want you to learn how to read a book map. I want you to learn how to trade. I already did the work. I already chain smoked and drank 27 cups of coffee for you. You don't have to do it. I did it already. So that's what I want you to do. I want you to take advantage of whatever human suffering, whatever you want to call it. I wouldn't really suffer. It was air conditioned. I was fine. But I'm just telling you, whatever I did, it's already done. I'm giving it to you now. Now you just got to do some homework on it. You got to prove the model out to yourself. You can't trade something that you don't believe works. I don't care what it is. I don't care if it's like the dealer calls your house and tells you go short at 87.50 in crude oil tonight. It doesn't matter. You got to believe. You go, why would that guy tell me that? And then if it goes up 2 or 3 ticks against it, you're like, see, I knew he was lying. It traded 83.55 today. That guy's nuts. Exactly, right? You got to figure it out. So here's some quick rules. POCs of the prior candle become the next candle support and resistance. That's a fact. Almost every time it retraces down in there. Carr's 1/3 rule is a pretty decent rule to live by. We use that information to refine the entry point. You have little to no drawdown, straight to break even, then the profits. That's how the trade structures out, man. If you hit that rejection point, your limit order comes in, you got a couple ticks draw, and you're gone. Sometimes you get first of all, sometimes you don't get filled, and a couple of times you get 1 or 2 ticks draw. The spread and 1 tick, 1 drawdown. Right? You're using the highest probable reversal point within the candles to lean on. Can you go 6 out of 10 with this? Listen, the numbers flesh out a certain way. Can you go 60% or better? Right? 60% or better. Yes. Can you trade 3 to 1 with this? Man, you could trade 3 to 100. You could trade some sick numbers in here. Okay, can you risk 10 ticks to make 30? Can you risk 10 ticks to make 50? Can you risk 10 ticks to make the entire ADR? Yes, because you're going to be at damn near zero for the day. And whatever it offers up is available to you. But you got to figure out a number that you can get off the system and go to bed and have a normal life. All right, I mentioned a couple weeks ago, some people are going through divorces. They're working their job, sitting in front of the screen, and the wife ain't having it, the husband ain't having it. And it creates problems in your marriage and your life. And that all plays into the entire business, man. If you got stuff going on in your personal life, you cannot sit there for 10 hours a day and focus on this stuff. Too much stuff going on. I completely understand. So it's Valentine's Day. Avoid that stuff. Take the time to be with each other. This stuff ain't going anywhere, man. I'm here. You're here. You just figure out a way to structure your life to where you can fit it all in and be a good parent, good husband, good spouse, good wife, whatever you need to be. All right, it's important. It matters. All right. So how do I get there without the tools? Box in the apex nadir, surrounding pins, tops, bottoms, on aggregate. Remember, take the bodies. Look for the zone flip area in the box is breached. Look for the first retest, rejected, right? The draw boxes around the high and low and look for the failed buyer and failed seller auctions, right? Look for the first retest of the ejected area. This is just rules, man. Take a screenshot of this, enter on the retest, UTI stops. Now, you need to relish in the fact that you just defeated or hacked, life hacked. People love this stuff nowadays. That's why I wrote this. You hacked millions of dollars in order flow tools and algorithms written by the dealers and coders against retail traders. You just defeated them. All that number bullshit, sequential decline, pictures of all this order flow, zones, all this garbage. You just, all that stuff, all those algos they wrote, all that code, all that, you just beat it. I'm handing it to you. This is, you beat millions of dollars in software development right now. I'm handing it to you. Just do it. Trust me, just do it. All right. Every instrument in the world is moved and manipulated by the process. Order flow in, order flow out, tapering, trap trader. That's the whole business in a nutshell. Every push and pullback is created by book or absence or presence of orders in the book. The levels can be used as alternate entry, trailing stop points, and add-ons, right? You can take that structure and trail your stop every time a box prints and price shifts through to the next level. They're basically M and W structures, and they offer the highest probable positive outcomes. Are you going to get every single one right? No, because sometimes there'll be a print that makes an M, comes back, retests, or instead of an AR0 trade, right? Remember, if you box this in, it becomes an AR zone. So sometimes it'll retrace to the AR50. What would be the deciding factor on that? Well, if you got a daily open up in there and you got an AR number, you can join those two together, and that's probably going to be the zone. But if you get an AR0 and you miss, you can take your order. If you're trading 10 contracts, go 5 here and 5 here, or go 6 and 4 to get a weighted entry. But understand that if the 4 goes off and this doesn't happen, you're not going to get your full order on. Okay, so split the numbers however you feel is comfortable. But if you know there's 2 possible zones and you're looking at an open, you don't want to be all in here and have to sit through that. That's the point of not doing that. So aggregate in at the AR0 and at the AR50. And when I say aggregate in, I don't mean like take triple your lot size and spread it out. If you're a 10 lot trader, go 5 and 5, 6 and 4, 7 and 3. If you're a 2 lot trader, go 1 and 1. If you're a 1 lot trader, go 0.5 and 0.5 minis. Okay, adjust accordingly. Don't be like, well, Steve told me to do this. I'm going to put 100 lots here, and I'm going to put 1,000 lots down here, and 6,000 lots over here. Don't. That's what people are doing. It aggravates the hell out of me. And then they bust their account, and of course it's my fault. I go, well, how much money did you have in your account? I had like $600. I see 20 lot trade on there. What are you doing? Well, I got 1,000 to 1 leverage. That's not how that works, man. All right. So look, I'm going to end this session in a couple of minutes. We'll look at the book stuff, and we just keep moving along. So this is a typical book print. This is what I want you to see. Okay, a lot of you have seen some of these charts, but I'm rehashing older stuff that I did because it hasn't changed. Since I started looking at this stuff in 2014, nothing has changed. The book is the book is the book. It's still doing the same stuff. But I want you to understand what you're looking at. All right, notice how they put, right? This is executed orders on the candle. This is orders in the book. This is Bookmap in the older version. I used to like black and white, so what I got used to, but the colors are what's in now because you can tell the depth of the order. Used to be like this gray color is low orders, and the brighter the white, the more orders. So I see the little slashes in there. That's absorption coming out, or them moving orders. All right, so let me clear this off. Take a screenshot of this. This is your tutorial right here. It's showing you everything in the book. All right, take it, take a picture of it, and I'll mark it up. Let me get this off. I don't know if you can see it on my screen. I wrote something on there and it's on there. Okay. Okay, cool. All right. So, and it's just basically what's going on, right? So now start looking at this in with a different eyeball. Start realizing there's an M. There's an M. There's an M. There's a flip, right? That's a baby zone flip right there, right? On top of that, there's an M. Okay. Wait, there's an M. Microstructure, there's a W, pullback. There's a W, pullback. Right? Now start looking at this stuff. It's everywhere. These are microstructures of a larger structure. So if you start realizing that all I'm doing is trading second leg of the M, right? Because you get first test, second test, right? This is the refined entry, draw it across there. You're using order flow. Well, how do you know I'm using order flow, Steve? Well, because look, right here, let's just take the high swing. Here's your M formation, right? Hit the stops, trap through, come back below. Okay, now, in order for that to happen, there had to be some order flow. The print was capped right there. And then this, look, this is high of the day, no question about it. That's it, right? And there's the insurance, 5 ticks above. Come hell or high water, nobody's getting through that level. There's thousands of orders sitting here, thousands. Nobody's getting through that unless they own a bank. Okay, so now there's your M structure. They capped the price at the high of the day right there. So this was a little bleed through. You can see that on the shadowing right there is a little black. There was probably a wick right to that area. And then they traded full body right to it and the wick went through. See right there, those orders are in. They stopped the wick right there. They capped it, right? That's called capping. They threw a block of orders above, capped it, and then they had insurance to make sure nobody's getting through. Okay, now price comes down, retests, comes down below here. There's where the book flips, pull back, you're trading the M short. Okay, so now once it flips over, this would be one of those instances where you had an AR50. Well, Steve, I can't see this order. Who needs to see it? It's right here. That's where price ended for the first test. You draw a box around that with the order flow. You're in the zone, man. Right there. There's your entry. Bam. Level 2 push. Perfect. You nailed it. I don't know if you can make a better entry than that. Okay, Steve, they shifted below here. Now what? Okay, where's the next spot? I don't know. There's the first turn. Okay, how do you know it's the first turn? Look at all the order flow in the book absorbed. They ain't letting it through. These orders from up here shifted down to here now. Now they're blocking at that level. Okay, how do I find the entry off of that, Steve? You take the rejection from the order flows. Look, when I draw a box, I'm just basically connecting the map points. Right? When I draw this box, I'm connecting orders that were in the book. It should be right there. Count it, every little level. 1, 2, 3, 4, 5. That's a 5 pip box. Put an order 2.5 pips in the middle of the box. You can't do a 0.5, so do 2 or 3, pick one. put a sell limit order, an SLO in the box, and just watch it go, man. There's your money. All right, Steve, I don't know what to do. Okay, it flips here, pushes down, pulls back, gives you another either stop goes there, right there. How do you know? Look, the order's in the book. How you know where it's going to come back to? It comes back to the swing points because the orders are in the book. It comes back, it's a near miss. You should be out here, and there's your next turn. If you missed it, you can go here. All right, this stuff should be making massive sense to you, right? Okay, we talked about this last week. This was a perfect chart someone sent in. It's beautiful. And the argument was, can you take this point or this point? This is obviously a clearing of the level and pull back, right? This is starting to form out the wedge. But here's the thing. Because of the way the orders move in the book, they're constantly in flux. So if you get a higher price, right? Look, lower price, bunch of orders. If you get a higher price, some order flow had to be there to stop that and cap it off. Look, this is the full trade right here. This is the full deal right here. An aggressive move towards the low takes out the high of the day, right? This is exactly the stuff we see on a regular basis. Comes all the way back down, apex nadery backed in, blocked in with all the POCs encompassed in there, and then there's a perfect entry, right? You would have, if you notice, some little wicks showing in here where price bled through it. I'm going to show you the candle overlays if I have time. I'm running out of time. I'm talking 100 miles an hour. I'm jacked up on Diet Coke, and I still can't get it all in. All right, so look, there's your flip, right? So you get a wick here, 1, 2, use the box. Look at how the white lines essentially draw the box for you. This stuff is drawing the box for you, man. It's like a gift from the Forex gods. They're literally, picture in your mind, right? In order for this to turn right here, there has to be order flow. Look at the white stripe that was traded into and rejected higher. So when you see a big, huge wick candle on a 15-minute, it had to be a stack of orders like that. When you see a turn point on a 1 minute or 5 minute, it was a little block of orders like this, just a tiny little block. They capped it and turn price. Absorb, turn. The dealers are always in, man. That's where the always in drill came from, because they're always in. They have to take the good and the bad. At the end of the day, they win the day. It has to be a net win. So they have to buy and sell to whatever people are doing. They have to take the other side of your trade. You know, they talk about order routing and matching. Yeah, they dump you off on, if you're buying and some schmo is selling, they're dumping you off or pairing you with that guy and you're evening each other out. But there's some net carry that they have to deal with. That's the business. But that's also why they control the entire business, because they have to take the bad with the good. But the idea for them is if they trade 100,000 net short, is to make sure that if price is actually going short, that they're only maybe 80,000 net longs. So they make 20,000 net, and I'm talking about contracts, I'm not talking about dollars. So that's on aggregate, they come out. So if you start thinking in blocks of 3 trades, right? How can I win the day, not win the trade? Okay, you take an aggregate of 3 or 5, and that's your max amount of trades, and you have to be net positive for the day. If you hit 3 in a row out of 5, you stop. If you lose one, win one, lose one, then you got to try to trade to the full 5 and come out net positive. That's what that webinar is about. I illustrated a perfect example of that. If you're going to trade like a dealer, then trade like a dealer, right? You're going to trade on the lunatic fringes of the move, right? Red Rider, that's a song from a wrestling movie I loved. I'm telling you how old I am. I think it was called Vision Quest. And some people are my age and they know what I'm talking about. Anyway. Lunatic Fringe. I love the song. And it's exactly what you're doing. You're a lunatic for trading on these edges. Anyone will tell you that. And everyone said I was a lunatic until now you could see it. Now you can't call me a lunatic anymore because I'm showing you what I always knew was there. I just never could see it and couldn't understand how to deal at those areas. Now we're dealing within five pips of the swings to the tick. And if you're trading a bounce trades do this almost always, right? Here's your moving average. It comes. There's the average right there. Bounces. Okay. You can take the first rejection off the 200 and box it into space, and you can put that on there. Go do it. Go look at it. Because this is inevitable. This and this. Look, there's a little M. It's inevitable. Are you going to miss some? Yeah, you'll miss some if you don't take the first iteration of it. But you can refine the entry on the first pin rejection off of any area on a chart that you feel is solid. There's candle overlays. It's probably the last thing I'm going to do because it's almost 8, and I started going over, and I don't want to do that to you guys. So I'm going to end it here. Last one, and I'll pick up right here next week, just like I did. I've been being better about that because you guys got tired of the motivation, and I guess I got the emails to prove it. So I'll talk about the calendar stuff and move right back into this stuff. All right. So this is what it looks like when you take the same levels and overlay the candle, right? These in here are the wicks, right? You could see it. See how it's very thin? Okay, well look, that's a little baby inverted hammer. See it? There's the wick right there. So why is it up here, Steve? Because this is 1 tick or 1 pip per stripe, and that is the spread accounting for the candle going to here and spreading 1 pip higher. So although it only traded to here, the 1 pip expansion put it into a higher point in the book. Start noticing that, right? The body's here, the wick's here. Okay, so if we know that it got trapped off of the real bodies and this is the high of the day, then we draw an aggregate of the tops of the bodies. Wait a minute, Steve, now it's coming together. You're not so crazy. If you see price wicking up and the tops of the bodies, we know that we're in a few pips of where the swing point was created by the dealers by looking at this order flow, right? So you had some, right, look, black, placed, capped it, gray, 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 shifts down a level, pressing price down lower to make price go away, pressing price lower. That's the area, that's the high of the day, and not another question about it. Why? Because they left a massive amount of order flow sitting on that level. Nobody's getting through that unless you own a bank. All right, now take out the apex nadir thing, right? You take the candles on aggregate in the bodies and draw these little swing points out into the future. How do you know I'm supposed to draw the swing points? Because in order for there to be a swing point, there's got to be stripes in the book and capping price and making it turn. All right. So now they break below. I got low side book. I come over here. It's a pretty good flip. I'm looking for a refined entry. I take this body top, this wick, and I aggregate this out, 3 tick box, draw it into the future. They come right back and test it. Look at that wick right there, capped by the order flow. That's a 0 entry if I ever seen one in my life. Lights out. Call me tomorrow. Okay? I'm going to end it here. It's 8 o'clock, man. So listen, do some homework for me. Send me some love. Send me something. Even if you just say, hey, man, sorry, I was busy last week. You could say I hate your guts, but I'm still here. I'm all right with that too. All right. You could even say I like Car and Jim better. I'm okay with that too. No, it doesn't matter, man. Just send me something. All right. So, by the way, this is the 50 EMA or volume weighted moving average price of price, VWAP. All right, man. I will see you next week. I'm jacked. I'll be this jacked next week. If you're not excited about this, you're in the wrong business. You got no pulse, man. All right. I love you guys. I know I gave you some tough love tonight. Don't be mad at me. Send me something. All right. See you guys next week. Appreciate it. Good night.